Hello, ladies and gentlemen. Welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. I'm very happy to say that our recent development and let's say our recent webinars spurred quite a bit of interest among traders that are not within our company and much more with those that are with us. Especially to what we've learned so far, especially from the investor sentiment that we discussed the last time, and also the possible interest rate hike that is probably going to occur today. Because today at 1900 GMT time, we'll have the Federal Reserve's interest rate decision, and half an hour afterwards, we will have the monetary policy statement by Fed Chair Janet Yellen. Among other news that we saw today from Great Britain, also from the Eurozone, pretty much the market has been muted by the looming interest rate hike. Now, what we spoke about the interest rate is extremely peculiar, besides the fact that it is inevitable in time. But what it means is that a rise in interest rates would only mean a rise in dollar, which is actually not automatically going to happen right away or inevitable. So, if the Federal Reserve hikes rates today, the global disruptive effect of the U.S. monetary tightening is going to result in a rapid rising in U.S. dollar, capital outflows from emerging markets, financial distress for international dollar borrowers, and of course chaotic currency devaluation in Asia, and of course other countries, Latin America, Europe, so on and so forth. So what the outlook for 2016 is going to be compared to the 2015 glance that we actually look back is that the next year's economic outlook will be less diverging and will be less stressful than the year that we are in right now. Therefore, when we already know, let's assume that the Federal Reserve hikes the rates in the evening today, that will only result in let's say, as analysts and news agencies like to say, it's going to cause a knee-jerk down on gold prices and probably on the euro as well. Basically on major, everything that is connected to the US dollar. But that, however, will be short-lived. Basically on the fact that the market has already priced in for today's interest rate hike. So what does that mean? That means that a very short-term dollar boost will be given by the Fed interest rate hike today. That will of course be, as we mentioned, short-lived, because the market needs to find its equilibrium to work well. So you see, when there is a financial distress, sharp moves and huge gaps can occur, especially in market openings. But once this first tightening policy occurs, from then on, what will be the most important thing for the dollar and vice versa for other currencies and commodities will be how fast the pace of hiking rates will be afterwards. Now, this is what we need to see and to hear most of all and to analyze in the statement of the Federal Open Market Committee by the Fed Chair Janet Yellen, which will happen half an hour after the decision has been made. So the decision itself will probably spur dollar boost for a very short period of time. The market will normalize itself 30 minutes after, when the Federal Reserve chair will have a word on the economy, and particularly on the policy tightening strategic moves further on in the future next year, is exactly what we need to talk about. Now, hawkish overview, hawkish statements from the Federal Reserve will cause the currencies against the US dollar and commodities that are also denominated in the US dollar to receive a bit of a pain in order to get back on the losses that might be caused after the announcement itself. Which means if rate hikes will be much more rapid and with a higher percentage point based on the statement, that will definitely mean that gold prices, other commodity prices in the major currency pairs, and dollar crosses will have very huge difficulty in regaining the losses that might be caused during that time. So it really depends on the announcement itself. It's not that much on the hike or not. Well, of course, it's quite obvious that if an interest rate decision today receives a result of unchanged policy, it will be no matter what Janet Yellen will say afterwards, because the Federal Reserve, the government itself, will get let's say a bunch of investors and traders that will stop actually trusting what they're actually saying every time, which means the particular trustworthiness of the government needs to persist throughout 2016 if we are going to have a stable market. Because having a stable market, ladies and gentlemen, will give us the opportunity to count on our technical side of the trading, which is by far the best type of trading, based on the fact that you have technical indicators or any other form of strategy that gives you assurance that the percentage of certainty of the market direction is yay high, let's say 60%, 70%, 80%, 90%. Now, then on, the stressfulness of the situation when you trade will be less on your psychology. The opportunities that we'll have will be much more. Therefore, the likelihood of the investors to trade particular units to bring volatility on the market on a regular basis will be normalized. So we will not count on major event announcements like today, like yesterday, for example, like tomorrow, to get some volatility to trade. During other times, you know, without any major announcements, you can see how sluggish the market is. You have barely a direction. And that's not fun at all, especially if you're a type of trader that relies on the technical analysis, or you have a technical strategy that works good for you and you want to use it. So you need normal market conditions. That means the Federal Reserve has to go with it just to deliver this monetary policy tightening, so they can normalize the market conditions. Once that happens, we can keep using our technical strategies, our technical analysis for short, mid, and long term, and rely on the signals that we're getting on our charts. Isn't that what everyone is looking for? Now, fundamental traders, of course, will not agree with me that much, because the more the market is stressed by certain events, statements, or any particular inflationary data, they are actually in their own calm waters, and the trading for them then means the heaven, because that's the only time that they can make their profits. But one thing we have to remember, and at least not forget, that fundamental events we will keep receiving on a weekly basis, on a daily basis, without a problem. But for those that are fundamental traders and let's say they prefer the uncertainty of the market, let me tell you that once today's event is in the past, not only the technical traders will benefit from that, but also the fundamental traders, because no more uncertainty. The next time we get some good numbers, let's say for United States, you are most positive that you will get a strength in the dollar. But what we're getting these days, yesterday on the consumer price index, did we see any particular boost in the US dollar? Not much. It was not changed with even an inch. We actually saw a bit of a downside as well, because the market is pricing for this rate hike. So what you can actually take from all of this is uncertainty on the market does not benefit anyone. It's better to have stable market conditions to make your predictions. That is why I'm not going to go too much into anything more about the interest rate decision, anything more about the investor sentiment, unless you guys have any questions in particular, or whatever it is, because today's interest rate decision is imminent. We will definitely have a decision. What it will be, we will find out in about 5 hours from now. So if there is anything you need to know, anything in particular that you are in doubt about, now is the time to forward your questions to me, and I will attend each and one of it without a problem. Meanwhile, until you decide whether there is something you want to ask or you're trying to formulate your questions, I want to turn my attention to what you see in front of you on your screens. One of the most volatile units, gold. I have not really decided to use it in particular, but we will take a look at the rest of the charts here for major currencies as well. But what I wanted to stress is on one of the successful strategies that we've managed to pack in to make it work good for us, for the team, to trade the market in technical level. It's making us very good profits. Now, the larger the time frame, the more accurate it gets. However, the best time frames to use for any particular day trader would be the 1-hour chart and the 30-minute chart. And what you see in front of you is nothing different from what we've presented in our advanced find the directions. Basically, the combination of the technical indicators that you see in front of you, the average directional movement index, the relative strength index, the moving average convergence divergence, and of course the stochastic oscillator, all of these have every particular setting according to its functionality to give us on-time signal without delay. However, mistakes in a technical system can always result in a loss.
Muted.
So I will proceed. The functionality of this technical system gives us a beautiful opportunity to find the direction and the entry levels. So as you can see here, this is a particular 1 hour chart on the gold unit. The idea is to find the actual trend. So as you can see here, this is just an event that happened yesterday. We have our parabolic support and resistance level as well. Now this particular oscillator or indicator gives us the opportunity to find exactly when the market is ready to give us a direction. However, the usage of the 200 exponential moving average is a must. Whether you're going to use a Bollinger Bands on this one or not really depends on what you like to see. However, the strategy and the let's say the visual look of the strategy itself and the combination of these indicators is pretty much the way you see it here. I'm using Bollinger Bands for a different reason, because on the other monitors I have different indicators, so sometimes I have to readjust a few things depending on what exactly I'm trading, but that is up to you. Now, as you can see here, we have an opportunity to see lower prices in gold. Once the parabolic reverses and becomes apart from the upside on these candles, then the price will be below the parabolic. From then on, we will have a convergence in the positive and negative directional movement indexes, and the ADX itself will start pointing upwards, where we can see a rise in volatility. Volatility indicators such as the relative strength index, the MACD, and the stochastic are also an integral part of this particular type of strategy. Because everything is based on volatility, we can rely on a direction in a short period of time. So we don't have to wait more than an hour or more than 30 minutes to close our successful positions. So the next movement here, from experience, from using this strategy in a long time, will be when we see this crossover of the red directional index pointing higher, the green one will point down. From then on, we will see that there is a bearish trend, short term, of course, and if it starts rising above the level of 20, which are customized levels for the ADX, also 27 or 28, so it really depends on how you will set it, but 27 usually looks like a good level. As you can see, pretty much the peaks are usually on 26 and a half, 27 would be nice. However, if you're after some extremums, you can see here that the 28 level is a pretty good extremum, especially if you have additional levels on the relative strength index, like a level of 80 for overbought conditions, extreme overbought conditions, and level of 20 for extreme oversold. It's not necessary, especially for those that can measure with the crosshair. You can see at what level the particular indicator is at the moment and decide for yourself what the direction would be. And the role for the MACD and the stochastic is pretty particular, actually, because what we need to see for direction is continuous trading on the histogram above the zero level on the MACD if we have an uptrend, or a particular, let's say, continuous trading on the downside of the histogram to suggest us a further downside movement. However, on the sidelines, you can see a very tight histogram without any particular direction, suggesting that the strategy that we can use in this stage would be buy and sell on the high and lower level on the stochastic and the relative strength index, because they're the perfect indicators to trade sideways direction. And you can see that the market is confined between two particular levels, 1085 here and 1067 here. For the time being, this is a sideways direction from where you want to look at it. But from then on, a slight downside has persisted due to the market pricing in for the rate hike. So you see, today the market will be a bit unpredictable, especially before the announcement. However, listening correctly into the 7:30 announcement from the Fed chair would be the key to your future tradings. Of course, we will bring down all the important information from this meeting in our tomorrow outlook. I will make sure that my colleagues will break this speech down in pieces and bring you the most important events and the conclusion from the whole speech, because I understand that there are traders, when they're listening to some announcements, usually those types of speeches makes little or no sense at all to the majority of traders. So the acronyms, the terms that are used in such events, we'll break them down in pieces. We will bring you the most exclusive information that you can use for future trading, especially when this particular event will give us the direction on everything next year. Of course, what we spoke about the last time was the investor sentiment for 2016. It was extremely important for those that were here, and the questions that you've been asking during the time and after, of course, that we've been receiving on our emails. Thank you for every single question, ladies and gentlemen. Everything is appreciated. Now, our projection, our expectations based on the investor sentiment on major currencies and commodities was mentioned at the last time. However, the only case that we're at this stage not considering as a positive term for trading would be the unchanged type of policy, which means no rate change, a bit of a mixed hawkish dovish statement from the Fed. It will bring a lot of uncertainty, and the trustworthiness of the government will be diminished. So I'm pretty sure that they don't want that, obviously, because they need to influence the markets in the long run. But if we have to have it as a possibility, a lot of things are certain. The dollar will be going at a lower levels. Major currencies will get a significant boost in the short term versus the dollar. So we can see a very, very huge spikes, especially on gold. We might even see about $50 to $100 in price change until tomorrow's session, throughout the Asian session itself. So those that are here and are usually trading throughout the Asian session hours, please remember, during that time, the market will be extremely volatile, simply because whatever is to be announced today will take effect during the night. There's a lot of markets that are opening during the Asian sessions, so we need to consider the possibility that all moves might be exhausted and we could be into a correction on the next session itself. So do not hurry and do not rush into positions when the market has already spiked, when everything seems to be at an end. Please remember, when the market spikes extremely quickly, it will come down eventually at some point. It will take a correctional direction, and will give you a better opportunity to enter on a more calm water, because then whatever profit you're making will be sustained. Because if you see a $20 spike in gold price, I'm 99% sure that you will see 50 to 60% retracement in the first 15 to 30 minutes. And this will be on profit taking. Huge spike, profit taking will bring down the price with 50 to 60% on the rally, and then we'll start gradually going higher and higher. But that we will follow on today's event, by far the most important events in the past decade. So for those that are coming on the markets for less than the past 10 years, maybe this will be the turning point on your career or on your trading experience. Now, let me say one thing here, ladies and gentlemen. On these types of events, people tend to lose a lot of money. That means the particular cash that you lose will go in somebody else's pocket. It could be your dearest friend, it could be your wife or your cousin. You have very little idea or none whatsoever exactly where this particular money is going. So, profits are there to be made. Please do not make the mistake to enter the market prior to the announcement or right after the announcement itself. Just wait for a few hours, at least 2, 3, maybe even 4 hours sometimes is necessary for a certain rally to end, find itself the correction, give some time to market analysts, news agencies if you wish, or for us to analyze the current conditions and give you the best opportunity for direction. Because it will be, let's say it is a 50-50 chance for you to make money. Now, because there are two directions markets will go today. Rate change, rate hike. Most of the currencies and commodities versus the dollar will go down in the short term before it starts stabilizing. Vice versa, everything will go higher. So there are two directions, and there are 50 to 50 chance that you can actually pick the right direction. So don't listen to market expectations and any news agencies that tells you we're pricing in for 70% rate hike. Now, how can you say that you have a 70% rate hike possibility because you have polled 10,000 people? What about the rest? I mean, you cannot poll the whole world, obviously. You have a bunch of market analysts and traders over there, which they have their own outlook. But what's left for the other hedge funds, major banks, big players around the world that also have influence on the market? Don't make the mistake to pick a direction or even, let's say, gamble on roulette, black or red. That's precisely what might happen. You are either going to double, triple, or quadruple your profits, or you will wipe out everything you have. So why would you actually take the chance to wipe your profits today for the mere 4 times bigger profit than your initial investment, instead of waiting until tomorrow and get double profits, but with much more certainty, because the market is already calmed down. It has already chewed the information that receives, and there will be no surprise of the next market move whatsoever. So obviously I will take my chances. Obviously I will stay up to the last minute, the last word that the Federal Reserve Chair will say, because I need to know how exactly I will be trading tomorrow, because I know the odds of the plus and the minus. If it's going to be a rate hike, I know what to do. If it's going to be unchanged policy, I know what to do. But still, market timing is the most important perspective, and the fact that the traders need to understand this and just nail it to your brain. Market timing. I will tell you what happened a couple of days ago. We got a news. You know, oil drops below $36 a barrel. It goes near to $35 a barrel, so on and so forth. And everyone is saying these are the lowest levels we're actually going to get, and there is only one direction for oil. That's to go up. Well, surprise, surprise, dollar slid with another $1.50 the same day, even though we saw 4 million barrels of deficit into the oil stocks. And this is not because people are scared because there is too much oil on the market. People are scared about what other people are saying, so they're taking their profits, they're leaving the market. And of course, oil start picking up. It climbed with $2, but that was not the reason, because they have actually said that, but they actually lured the small game into a trap to lose their own money so they can collect it for themselves. Now, I'm not saying this just because I need to say something, but a mere speculation, and if you wish, a research says that people tend to lose much more money when there is a huge announcement with higher percentage of certainty than when there is no announcement at all with very tight volatility. So I hope you understand exactly what I'm trying to tell you, but please be aware, stay away from the market, at least for today, if you want to stay long enough to start making your profits correctly. Well, I'm not going to lose too much of your time. You can see the type of strategy that we will be using next year, first quarter, until there is something else better on the market to be used. Not tomorrow, I'm sorry, the day after, that's Friday. Friday we will discuss a few other a few other strategies that will be very useful for you. Actually, there are two particular which are unchanged so far, and they're working well. So I'm going to present them to you. There's nothing different from what we've spoke so far, but there are those that we don't really tend to use in the first quarter next year, because it will be the year when the market will start stabilizing itself, will pick a direction. So the most positive strategy so far is this one, and those two that we'll talk about on Friday. And of course, we will talk again on the events that are going to happen today. I will also give you some more outlooks on a fresh new information now on something that we can step on something concrete. So then I will either adjust other strategies, or I will just give you some potential in outlook for the firm and what we're looking to trade, which direction we're looking forward on an annual basis. So this you will receive on Friday. For now, protect yourself, protect your investment, be safe. Thank you very much. I'll see you next time. Bye-bye.